Hi folks, welcome to this video on the consolidation process. In this question, we have a company Grant who on January 1, year 4 bought 80% of the outstanding common or voting shares of Lee for $70,000. That 80% represents 8,000 shares. Now, it said at the date that the two companies became related, Lee had common shares of 25,000 and retained earnings of 30,000. That's important for us to know because that amount of common shares and retained earnings needs to be eliminated before we prepare the consolidated statements. Don't forget, when we prepare consolidated statements, we don't want to show any common shares except the common shares that are owned by Grant's shareholders because they do the consolidation, right? And we don't want to show any retained earnings of Lee because those are retained earnings that were earned before we became related. So it's important to know the common shares and retained earnings of Lee, the subsidiary company, at acquisition date so we can eliminate those. Now, we told you that on the date the two companies became related, Lee had identifiable net assets in terms of inventory and patent that had a carrying value different from fair value. That's important to us because when Grant bought Lee for $70,000 in cash, it made these fair value assessments. So Lee was carrying inventory at $50,000, but Grant thought it was worth $5,000 more at $55,000. Similarly with the patent, Lee's holding it at $10,000 at the date they became related, but the parent now, Grant, thinks they're worth $20,000. So it paid for that increment, the $5,000 increment on the inventory and the $10,000 increment on the patent. So we need to consider that when we're doing our acquisition eliminating entry. Now we know this patent has a remaining useful life of 5 years and all of the inventory was sold in year 4. That makes sense to us because inventory is a current asset. Grant is using the cost method. Now, to account for the investment. Now, with the additional information, we know that at December 31st, year 6, which is the year for which we're doing consolidated statements, we know goodwill has a recoverable amount of $10,000. So we're going to be using that to help us determine how much of the impairment was. And we know all that impairment occurred in the current year, year 6, for which we're doing consolidated statements. We also know that Grant's accounts receivable contains $30,000 that Lee owes them. So we have an intercompany accounts payable and accounts receivable that we're going to have to take into account at the time that we prepare our consolidated balance sheet. And we also know that any amortization that we're going to calculate, which don't forget that would apply to the patent for sure, is going to be grouped with distribution expense, and impairment losses, definitely the goodwill has been impaired, is going to be grouped with other expenses. We have the separate entity statements for Grant and Lee, balance sheets at the end of December, year 6, and we also have the income statements for year 6. And what we ask you to do is go through all of the steps to create schedules to show us how to calculate the acquisition differential, goodwill, and non-controlling interest at the date the two became related, January 1, year 4. And also to prepare the eliminating worksheet entry to facilitate the consolidation process at the date the two became related. And then we want you to do an amortization schedule for the amortization of the fair value increments, including any impairment losses, all the way from January 1, year 4, the date they became related, to the end of year 6. And then we want you to calculate consolidated net income for year 6 so that you have a check figure to do part E, which is to prepare the consolidated income statement for year 6. We also want you to calculate consolidated retained earnings in NCI and the consolidated balance sheet so you can prepare the entire consolidated balance sheet using the separate entity balance sheets you had in the question. And then now in the last part, assuming that instead of using the cost method, Grant used the equity method, what would the investment in Lee, the subsidiary company, show on the separate entity balance sheet of Grant at the end of year 6? So this is our question and our required. It's a fairly large question, so let's see what the solution would look like. So first of all, we had to do the calculation of acquisition differential, goodwill, and NCI at acquisition date. So we know that for an 80% interest, Lee paid $70,000. But don't forget, Lee controls 100% of all the identifiable assets and liabilities. So we need to calculate what do we think they would have paid if they had bought 100%, because even though they only bought 80%, they control 100% of those net assets. They would have paid $87,500. What did they get for that $87,500 in net assets that they control? Well, they got the common shares and retained earnings, which is the carrying value of Lee at the date they became related. You remember we told you what these were in the question right at the very beginning, right? Right here we told you that common shares of 25,000 and 30,000 of retained earnings. That was at acquisition, right? So now, when we compare the value of the net identifiable assets they control to the carrying value of those assets, we get 55,000. So the difference between that 55,000 and 87,500 is 32,500. That's your acquisition differential. So what was that extra value over and above the carrying value? What was that attributable to? Well, in part, that's attributable to the increment on the inventory. You'll remember in the question, we told you that in the inventory, we thought it had a fair value, we being Grant thought it had a fair value of 55,000, whereas the carrying value on Lee's books was only 50,000. So that's an extra $5,000 worth of value. And you'll recall there was an extra $10,000 worth of value in the patent as well. So $15,000 of that additional $32,500 worth of value is attributed to the inventory and patent. So what we can't attribute to any other assets must be attributable to the goodwill. So that's $17,500. So using the entity theory, which we've said we will always assume the entity theory is being used unless you're told otherwise. So to calculate the NCI using the entity theory, we're going to take NCI share of the implied value of 100%, and we're going to get $17,500 as our NCI at the date we became related. So we can use a lot of these figures here, 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 and here to help us do the acquisition eliminating entry. So what's going to happen? Well, don't forget, to facilitate the preparation of the consolidated balance sheet at the date we become related, we don't include the common shares and retained earnings of Lee at acquisition date. Why? Because the shareholders of Grant for whom we're doing these consolidated statements, they're not shareholders in Lee. They are shareholders in Grant, so they don't want to see the common shares of Lee. So we debit them on the consolidation worksheet, not in any separate entity statements, to eliminate them. We also don't want to show in our consolidated statements any retained earnings of Lee at the date we became related, because Lee earned those retained earnings on its own before they became related to us. The other thing we want to do is we want to set up the goodwill, because that needs to show on the consolidated statements, and we also want to set up the inventory and the patent increments, which we showed here on our first calculation of goodwill. So we want to set those up. We also want to set up the NCI, because that's our starting point for that balance sheet account on the consolidated balance sheet. But don't forget, because we're picking up the fair value or the carrying value plus the increments plus the goodwill, that's going to eliminate the investment account for $70,000, because to include it, we've said before, this would be double counting. The investment under the acquisition method is the carrying value plus the fair value increments. That gives us fair value. So we're setting that fair value up in the consolidated statements. So we don't want to include the investment account there on the consolidated statements, because it's kind of broken up into its component pieces, which is the goodwill, which are the increments, and the carrying value. Those three items make up the value of the investment. And then again, don't forget our NCI is there as well. So now, to do the schedule to record the amortization and impairment losses all the way from the year 4 to the end of year 6 or to year 6, let's do the calculations. Well, don't forget, we have to amortize the inventory increment and the patent increment. And don't forget, goodwill is not amortized, but it is tested for impairment. We calculated goodwill at the beginning of year 4, that's the date we became related, and we set up the increments. Now we know that because the inventory turned over entirely in year 4, if we look at years 4 to 5, in year 4 we would have fully amortized that increment. So we would have nothing left to amortize at the end in year 6 by the end of year 6, because the whole thing was amortized in year 4. However, with the patent, don't forget the patent had a remaining useful life of 5 years. So if we divided this guy here by 5, divided by 5, that would give us 2,000 a year, right? But that 2,000 a year is 2,000 for year 4 and 2,000 for year 5. That gives us a total of 4,000. Now, the reason why, again, we've said this before in class, but just to clarify, the reason I'm combining the 2 years here into one column is because I want to separate out the year 6 impacts, because these amounts here are going to be what adjust the sub's income, that's Lee's income for year 6, to help me calculate consolidated net income. So I want to separate those guys out. So I combined year 4 and year 5 in one column so I could showcase year 6. You could do year 4 and year 5 separately if you want, you don't have to. But in this case, we know that over that 2-year period, we would have amortized 9,000. Don't forget, they told us all the goodwill was impaired in year 6, so we're not recording any impairment loss or noticing any impairment loss for years 4 and 5. But notice now when we get to year 6, we know that, don't forget, the inventory increment's already been settled or handled, written off. Why? Because the inventory's gone, right? We have 2,000 attributed to the patent in year 6, right? And that's going to give us a carrying value for the patent now at the end of year 6 of 4,000. Now, we have goodwill here. We were told that the recoverable amount is 10,000. Well, to get from 17,500 to 10,000, 7,500 must have been impaired, so we can work backwards to figure out that number. So we have amortization on the increment for the patent, which was a $10,000 increment in year 6, plus we also have impairment of 7,500. And in the next step, we're going to use these two amounts to adjust the income of Lee. So Grant's income for year 6, to calculate consolidated net income, we start with Grant's separate entity income, which is 230,000. The question did not say anything about any dividends declared and paid by Lee to its owners. Part of 80% of the ownership is with Grant. So we do not have to adjust this for any dividends, intercompany dividends, because there were none. But we do have income from Lee, which we're going to adjust by the amortization in year 6, as well as the impairment loss in year 6. So that's going to give us income adjusted for Lee of 13,500. So we know our consolidated net income for year 6 is going to be 243,500. Now, how much of that 243,500 gets attributed to Grant's shareholders? Well, don't forget, Grant's shareholders are shareholders in Grant, so they're going to get their full 100% share of Grant's income. Plus, they're going to get their 80% share because Grant owns 80% of the outstanding common shares of Lee. They're going to get 80% of Lee's adjusted income. So that's going to give us, when we do this math, 240,800 attributed to Grant shareholders. The difference between 240,800 and the 243,500 is going to be the amount attributed to the NCI shareholders, or it can be calculated quite simply as 20% of the adjusted income of Lee. Why could we do the calculation that way? Because don't forget, the non-controlling interest shareholders are shareholders in Lee. If 80% of the shares of Lee are being held by Grant, then 20% are being held by the NCI. So NCI is entitled to 20% of the adjusted income of Lee. So that's 2,700. So if we add these two numbers together, we do get 243,500, which is exactly what we should get for consolidated income. Now, we have to make sure that when we do the consolidated income statement, we are showing this amount for consolidated net income. So let's go down to the consolidated income statement. Well, again, we take the sales of Grant and add to that the sales of Lee. We take the cost of goods sold of Grant and add to it the cost of goods sold of Lee, and we will get total gross profit here of 680,000. Don't forget, when we calculate the distribution expense, we not only take that of grant and add lease, but we also have to include the amortization on the patent in there. Because in the question, that's what they told us to do. They told us that any of the amortization expense is grouped with distribution expense. And we calculated the amortization expense for year 6 to be $2,000. That was the amortization on the patent. We also know that in the other expense, in addition to grants other expense and leaves, we had to add in the impairment loss. Again, the question told us this. It told us that the impairment losses are grouped with other expenses. So again, we would now have that in with that account, other expense, and that would give us $243,500. So now, if we add the income tax expense of grant to Lee, we're going to get $136,000. So you can see here, when we do the addition of all these consolidated amounts on the income statement, we are going to get the same as we did when we calculated consolidated net income, which is $243,500, the same as in D. So again, we do this step. Oh, this should be D. I don't know why it's showing A, but anyway, we'll see if we can change it. Okay. Oop, didn't want to do that either. We'll do it like that. So now you can see that this $243,500 here and here is the same as we should get in the income statement. So we can use this as a check to make sure that we get the right numbers when we do the consolidated income statement. So we always use this calculation of the consolidated net income amount as our check figure for when we do the consolidated income statement. So now, the next part of what they ask us to do in the question is to calculate consolidated retained earnings. So let's stop for a moment here, and we will do this calculation in the next video. So sit back, relax, review the first video, review the problem, and we'll get back to doing now the consolidated retained earnings in our second video, as well as NCI, to get us set up to do the consolidated balance sheet.